Good evening, everyone, and welcome to the NGEN Markets Training session for today. I welcome you all. So, today's session, we are going to be talking about analyzing portfolios for client retention. So, there are four subtopics for today. One of them is exploring the client section, where we will be taking a look towards the RTA integration. We have portfolio analytics for existing clients. So we will take a look towards the entire portfolio analytics. We will then consolidate portfolios to analyze family portfolio analysis to see if it is, properly maintaining the risk profiling for that particular set of a family or not. And then we will be taking a look towards generating customizable report, which is PowerPoint report. And we will also take a look towards some of the other reports like the web-based report for your own review. And then we have the Q&A. So if you have any questions, any queries, you can write it on the chat box or verbally after the session, and we will try to address them. So welcome everybody. I will just start with my session now. I will show my terminal. So this is the NGEN Markets terminal, as you can see. And here, what our session will show here is that we will be taking a look towards the client section. Now, the client section, previously what we have actually discovered was taking a look towards value at risk for the mutual fund analytics. So here, what we are going to be taking a look towards for the client section. So this is the section, which is the third last section here. And the section shows you the three tabs. So one of them is the RTA connection tab. Other of them is the manual data, and then there is a fund expert tab. So I'll explain all of them one by one. But the first tab, which is our most important tab, is the RTA connection. Now, this RTA connection tab is very useful tab because this section was essentially created to alleviate the workload for adding the manual data sets for all our clients. So what you can effectively do is you can onboard our ARN through our RTA team, and we can now capture multiple ARN in our system. So if you want to capture multiple ARNs, you can easily do it in our system and consolidate them. And here what you can do is you can then review the entire dashboard. So now we will take a look towards the dashboard of the entire client section. So within this dashboard, as you can see, we have the summary. Now this summary will show you the ARN number one's summary of the AUM, number of the clients, average AUM per client, and the top 10 clients per AUM. So what you can see here is that effectively, you can see that this is the AUM, which is 38.18 crore. And if you want to see the top 20 clients, for an example, what you can do is you can effectively type in 20. Now this top 20 clients actually accounts for 46% of the total AUM. So that's how you can take a look towards your entire AUM summary, and you can change it to top 20 to top 25. So I can even change it for top 50. And you can now see that the entire 50 sets of the clients account for 26.16 crore of the AUM, which is 68.52% of the entire AUM. Now here we also have another very interesting function, which is called as the client holding search. Now, the client holding search helps us to determine that how many of the clients are holding one particular set of a fund. So you can either type in an ISIN code or a security name. Let's say we are typing in a random fund like DSP Midcap. You can now see that DSP Midcap across 47 clients, we have 1.4 crores. And you can now click on this particular set of a fund, and you can now recognize that these are the clients which are currently holding DSP Midcap as a mutual fund. So you can easily sort in based on AUM, based on the holdings, and also based on holdings in percentage. So here a couple of clients are holding 100% of DSP Midcap in the entire set of their portfolio. Now, let's say if you want to take a look towards one of the client, what you can effectively do is you can effectively click on one of the client here, let's say Pranav Dalal. And once you click on it, you can now see the entire portfolio of that particular set of a client. So let me just open that client again. So once you click on the client, just a second. Yeah, so you can now see any of the clients which is holding that portfolio. So couple of clients, this is a demo version, but in your RTA section, what you will be seeing is the holdings for that particular set of a client. So just like this, it will be shown as 12 holdings and the latest AUM as 1.22 crore. So that's how this works out for the client holding search. If you want to go back beyond the dashboard again, what you can do is you can click on this RTA connection again, and you can see the dashboard again. Now, this client holding search also works out for a debt category fund as well. So not just for equities, it works out for the debt, hybrid, and all other categories of the funds. So you can search in, let's say, ICICI Prudential Credit Risk, and you can see that 7 clients are currently holding this credit risk fund, and these are the AUM holdings and the holdings in percentage. So that's how this works out for the client holding search. It helps us to determine that any of the client, are they holding one of the fund which is currently not performing well in the market or not, if we have suggested those funds in our entire AUM set of the clients or not. So that's the client holding search. Now we also have this top 5 mutual fund exposure. Now, if you want to take a look towards the exposures of the mutual fund, which are the top 5 exposures, which are the mutual funds which you are actually suggesting to your own client base, you can check that here in the system. Now here there is another functionality is to click on the name. Once you click on this bar, you can now see the client name in the client holding search. So basically this top 5 mutual fund exposure is actually connected with the client holding search. So let's say that the second best mutual fund which I'm suggesting to my client is 3.65 crores. What I can do is I can effectively click on it and I can recognize that who is actually holding ICICI Pru Balance Advantage Fund in the client holding search, and these are my clients, right? So this is how it works out for the top 5 mutual fund exposures. Now we also have other stats. So for other stats, what we are going to be taking a look towards is the top asset class which we currently have in our dashboard. So in this case, you can see this is equity. We have equity as a mutual fund category, and we have this hybrids, and then we have the debt. So you can take a look towards the top stats do we have in our entire set of an AUM. And you can also see the top AMC exposure. So in this case, you can see ICICI, HDFC, Aditya Birla, DSP, and Bandhan Mutual Fund as an entire set of an AMC exposure as a top 5 exposure in our AUM. Now, there is another important thing, which is the top 10 clients, right? So this top 10 clients, which you see here, is actually connected with our top 50 clients per AUM. Now, what you can effectively do is if I do this 10, you can now see that it is now being changed into our system. And you can now see that the Sahil Chawla is the biggest client in our system, and you can check all the clients into the system. So that's how this works out for the dashboard. And that is where you can check the entire set of your clients within one single ARN or consolidate it. So if you want to consolidate, if you have already onboarded the clients in our system, what you can do is you can click on this tab, which is called as consolidated, and you can now see the consolidated data of multiple ARNs. So we now capture multiple ARNs. You can easily get in touch with our team, RTA team, if you want to capture your multiple sets of ARN for your engine markets terminal. And here in the settings, once you click on it, you can see that how many ARNs do we hold and what are the emails for those ARN as well. And here also another important thing is that we also display that is the data being received or not. So for an example, if you want to take a look towards the ARN data sets, which is coming from CAMS and Carvi, you can effectively take a look towards here. So if it is received, you will see that it is received, no update yet. But if it isn't, you will see the date set when it is last received. And you can also download these data sets in an Excel file. So all your clients will be downloaded with their latest client portfolios in a singular Excel file, and you can use that data sets for your own preferences. So that's how this works out for the RTA connection. And let's go ahead with our portfolio analytics here. Now for RTA connection, definitely you can recognize which of the clients are holding that particular set of a fund. But how about we search and filter clients? If you want to search and filter clients, you can easily do that in our left tab. So you can see there is a list of all the clients here in the left side, and you can easily filter the clients. So let's say if I want to know that who are the clients which are from Sharma family, I can easily see that these are the clients which are currently we have. You can easily search the client from here. Let's say you are searching from a keyword, and you can click on that client, and you can now see the portfolio of the client with the latest AUM, with the current holdings and the holdings update as well. And you can also see the SEBI classification invested in and the asset allocation. So this is just an overview of the portfolio with the funds which the currently the client is holding here in the system. Now there are other tabs as well, like sending the client portfolios to the client section. So I will discuss about this later on. But the main point here is that after you take a look towards this entire portfolio review, which shows you all the units and the values, what you can do is you can effectively run the analytics. Now here, once you click on run analytics, you can now see the analytics will be running for that particular set of a client. And you can see several tabs which runs from asset allocation to beta. Now in this session, I will be just showing you the overview of the analytics, how it works out, how you can use couple of tabs to actually help the retention for the client. And one of the tab is definitely the asset allocation, because here you can effectively review the tabs of the holdings which we have, which is the 18 positions which we have within a single go. So you can now see here within asset allocation the overview. So here, as we have the 18 positions within overview, we are showing you the exposures of these 18 positions. So exposures in the sense that the Axis Bank, which is an equity, which is a stock, how many of the mutual fund are actually given an exposure to Axis Bank. So what you can effectively do is you can click on this I button, and you can now see that these are a couple of funds which are actually giving an exposure to Axis Bank in our portfolio. Similarly, you can take a look towards other sets of exposures as well. Now, as you can see, this is all my exposures, right? What you can effectively do is you can effectively click on this detailed view. Now, within detailed view, what happens is the debt portion of this entire portfolio gets a breakdown approach. What you can do is you can click on it. You can now see that the debt is actually broken down in NCD, government security. You can see the T-bills there. So what you can do is you can click on NCD, and you can now see that these are all the NCD exposures. And once you click on this I button, you can now see that it is coming from HDFC Hybrid Debt Fund. Similarly, once I would like to know that what about the T-bills? If I want to click on it, you can now see that it's coming from two funds, which is Balance Advantage. Another one is a Pharma, Healthcare, and Diagnostic Fund. So that's how this works out for checking out an exposure of any particular set of a portfolio for any security. So these exposures are broken down in a detailed view. You can effectively take a look towards it through different sets of exposures like REITs, even derivatives. So that's how it works out for the overview section. Now, if you want to download the datasets in this overview, you can easily do that from this exposures. All you need to do is click on show all, and then all the exposures will be shown here in the system. And then you can download this exposure in Excel. It is a CSV file. It downloads all the exposures which is shown in the list. And that is how it is for the overview. Now let's head over to the other 5 tabs. Now, other 4 tabs which we currently have. What you can do is you can also take a look towards the concentration here. Now, the concentration is connected with the overview where we are taking a look towards the exposures, because these are the concentration of the exposures itself. Now, the top 3 exposures which we have, let's go to the overview back again. And you can now see that these are the top 3 exposures we have in our system, which includes ICICI Bank, SDFC, and Sun Pharma Industries. Once you click on the concentration, you can now see that it's the summation of the 3 exposures we have. So that's how it works out. So is our portfolio on an exposure level highly concentrated or not? That is what you can take a look towards on an exposure position concentration analysis. Now, what you can do is you can take a look towards top 5 exposure, top 10 exposures, and even top 20 exposures. So top 20 exposures comprises of all the exposures, which gives us 31.73%. Now, here we also have the equity market cap exposures as well. So if you are reviewing the entire portfolio on an market cap level, how much do the large cap constituents are there in the portfolio. So what you can do is, as we are taking a look towards only the equity side of the portfolio, here we have given a drop down where you can click on as of equity exposure. And you can now see that as of equity exposure in the overview, as you can see that the entire portfolio only contains 79% of equity. And within that 79% of equity, we have 53.19% of large cap as an exposure. Then you can check there's a mid cap and there's also a small cap as an exposure. So that's how this works out for the concentration. And you can take a look towards this as it is connected with the overview itself. You can effectively check the exposures of the portfolio within a single go. Now here we also have 4 more tabs, which are AMC exposures. Now here, what you can effectively do is you can effectively recognize that what are the AMCs which are highly concentrated towards. So for an example, you can see that these are the top 3 AMCs: ICICI, HDFC, and Kotak Mahindra. And you can click on it and you can see that these are the mutual funds which comprises and gives the exposure of the AMC. So ICICI, we have 3 funds. You can click on the HDFC, Kotak Mahindra, and that's how it works out for the AMC exposure. And you can also download these data sets in Excel. Now here we have 3 more tabs. So I'm just going to skim through this tab and show you how it works out. Like for an example, if you just want to take an overview of the entire portfolio. So the portfolio is Sam Bedi. We have the overview shows us the as of the entire set of the portfolio, the 73% of them is actually having equity as a category, as an asset class. And you can also see the hybrid as another asset class we have. So effectively, we do not have too much of a debt. We already have just hybrid and the equity funds. And you can also see that what kind of a funds do we hold within equity as well. So we have sectoral pharma, small caps, we have value fund, and for dynamic asset allocation, definitely it comprises from the hybrid mutual fund category. And that's how you can take a look towards it into the system. Now here, one tip here is that wherever you see the names of the categories of the funds, what you can effectively do is you can click on those names and you can effectively remove them or add them into the system. So for an example, if I'm removing these categories, I can effectively see that how many of the entire set of a category do I hold in the portfolio based on mid cap, large and mid cap, sectoral pharma, and then large cap fund. So that's how this works out for the funds as well. So this works out everywhere, even for solution oriented. If I remove it, you can now see that hybrid and equity is there. If I remove the entire equity, it will just show you 22% hybrid. And the main point here is that whatever you select here will also be generated in the PDF report or the PowerPoint. So the point here is that, whatever you give the selection to the analytics, the seamless portfolio report generation will show those particular set of the report accordingly. Similarly, you can go ahead with the equity sectors and debt. So for the equity sectors, we are just looking towards the equity component of the portfolio. So for an example, you can see the top 10 equity sectors we have is banking, pharmaceuticals, and IT. Now, what you can do is you can click on this banking and you can see the stocks in banking. Effectively for pharmaceuticals, IT software, finance, chemicals, and this is how it works out. You can effectively recognize which of the stocks are coming from that sectors. Like for cement, we have these are the stocks which we have, and we can also take a look towards the debt portion of it. So debt portion, what you can do is you can effectively see that currently we have a couple of debt funds. So debt in the sense we have hybrid funds. So what you can do is you can see the hybrid funds here, and you can see the YTM for that hybrid funds. So for a YTM, what we have given here is that there are four funds which comprises of the average YTM for the entire portfolio, which is 7.76. But once you hover your mouse on these sets of funds, you can see the average, you can see the YTM for that particular set of the fund itself, right? And what you can do is you can effectively see the average maturity as well. So for the average maturity, you can see the average maturity for the entire set of four funds which we are giving an exposures into the system for the entire set of the analytics. Now that's how this works out for the debt, because for the debt, whatever mutual funds you add, like the debt mutual funds or even the hybrid mutual funds, that component of it will be shown in the debt portion of the entire analytics. So that's how this works out. So I've just got a chat message. Is my voice audible? Please write me on the chat box and let me know. Yeah, sure. Okay, so let's continue. So here what you can see is that you can effectively also check the portfolio credit ratings. So for the portfolio credit ratings, what we have given here is that on an as of total portfolio, these are the credit rating exposures, which is AAA equivalent, sovereign, and then we have net C and others. And what you can do is you can effectively check as of debt exposure as well. So for as of debt exposure, what you can do is you can see that once you change it as of debt exposure, you can see the 50% of it is AAA equivalent. So this is actually more accurate because you are only taking a look towards on a debt side, and on as a debt side, you can see as of debt exposure, what has been the credit ratings accordingly into the system. Now, accordingly, we also have other tab, which is actually giving the entire debt exposure for the portfolio, because we do have four funds, and these four funds comprises of many debt securities. You can download them in Excel and can take a look towards it with the allocations itself. So that's how it works out for the entire asset allocation. It's a huge tab. It helps us to recognize on a fundamental level that what the current client do we have, which with the 18 positions is holding on a debt and the equity side. And you can also see the exposures and the concentration. Is the client too much concentrated on an exposure level? If the top three is like 40%, then that is a too much of a risk. So that's how you can take a look towards on the entire asset allocation level. Now, coming towards the asset allocation, we would definitely want to look towards the fundamental level of the positions, because for the positions, we would want to know that are we diversified or not. So what you can do is you can take a look towards correlation analysis. Now, correlation analysis is very useful if you want to take a look towards all those funds or even the securities. On the client level, you will see all the mutual funds here. But if you're taking a look towards on a portfolio level, which is, on a portfolio analytics, you can even add in stocks and check the correlations between stocks and mutual funds and other securities as well. So here in this case, we have fundamentally all of them are mutual fund. And when you check the correlations here, like for an example, we are checking Aditya Birla Sun Life Equity Fund versus ICICI Prudential Value Discovery Fund. Now, in this case, both of them are having a very high correlation. Now, the definition for the high correlation is pretty simple. What you can do is it is closer towards one. Any number sets which are closer towards one, like 95, 92, 97, 98, these are high correlations between the equity mutual funds. Whereas for a lower ones, all you need to do is to recognize that it is actually farther away from one or closer towards zero. So for an example, if you can see here, now, yes, definitely there will be a definite lower correlation between a small cap fund and a hybrid debt fund. But that is a fundamental way to check that are they really correlated or not. You can see here the correlations between the two funds, which is 0.72. And effectively, you can also check the correlation between a pharma fund and a value discovery fund. You can see it's 0.50. So that's how this works out for the correlation side of it. Now at NGEN, what we do is we calculate correlations on daily basis, on daily data points. Now this daily data points you can see here is that it's 2nd November 2009 till 4th May 2023. Now here you can change the start date and end date. Due to our calculation of daily data points, you can effectively change the start and end date. So let's say for an example, I would like to know that between 2020 to 2022, what has been the correlation between my portfolio, right? Between all the assets which I currently hold as a client named Sam Bedi, what has been the correlation? So what you can do is you can effectively choose the date accordingly into the system. And once you run it, you can now see the correlations accordingly into the system. Now, effectively, you can see that the correlation between couple of funds like, the ICICI Pru Balance Advantage versus DSV Small Cap is actually changed. And some of the parameters are also changed here. Like here, you can see the 0.97 versus Aditya Birla Sun Life Frontline Equity versus Sun Life Equity Fund. And that is how it works out. You can check the correlations between the two assets between two data points. So you input two dates accordingly into the system, and you can now see the scenario based on that particular set of a correlation. Now, in this case, once you run the portfolio analytics, normally what our software does is it connects the start date and the end date, which can be any particular end date, which can be the end date of the current date set. So what you do is, let's say if we choose in 5 year ago, what happens here is that we'll now choose from 1st May 2018 till the current date set. So once you go back to the correlation, you can now see that it's 1st May till 4th May 2023. So that's how this works out for the correlation. The entire analytics will be governed by this start date. You can change the start date effectively. You can have your own custom date and the minimum common period if you want to have, and then check the correlations accordingly into the system. And down, you can also download this correlation matrix for your own further analysis in an Excel. So that's how it works out for the correlation. Now, let's say if you have recognized that there are two funds like Tata PE Fund and Aditya Birla Sun Life Equity Fund, and you would like to remove one of them, you would like to see if it is viable to remove one of them and which one should we remove. So here we have another tab called the contribution tab. So once you have checked correlation, you can effectively jump towards the contribution tab. So within contribution tab, what you can effectively see here is that there are all the funds which we have. Now, this contribution is very useful because here we show you two sets of parameters. One of them is the total return parameter. Other of them is the contribution to the return. Now, this contribution to the return is actually been governed through the use of asset allocation. So on a total return side, definitely ICICI Pru Pharma, Healthcare and Diagnostic Fund has given the better, return sets. But as our asset allocation to Kotak equity opportunities is actually higher, you can effectively see the contribution to the return is higher in the entire set of the analytics. You can see Kotak equity opportunities is the highest allocated fund in our portfolio, right? So here what you can do is you can now click on the contribution here. This is the bar graph which we have. And once you click on it, you can now see the total portfolio return. You can see the fund's performance as well between the periods. And you can also see the asset allocation, which is allocation in portfolio for that particular set of a fund, right? And the total return, what we have is the total return between the period of 2018 till the current date set. So the total return can change if you change the start date. So for an example, this let's say what you can do is, let's say we are choosing 2015 as a start date and end date as 2020, right? So what you can do is you can effectively see the total return between the assets. So some of them, especially mid caps, have actually underperformed. That, as you know, that the COVID period was there in the March 2020. You can now see that these are the total return in the assets. And effectively, what you can do is you can reset this up based on the start and the end date, and you can see the entire total return. Now, this particular set of contribution analysis can be used for a different date set as per as I've already stated before, that for correlations we are also calculating the data sets daily. Similarly, these daily data sets helps us to recognize the contribution on a start and end date. You can choose as many start and end date as possible for the your own purposes. Let's say we are choosing 2015 to 2017, and you can effectively see the contribution between these two dates, and that's how it works out. So you can now recognize that which of the funds have actually contributed highly in the particular set of a portfolio between 2015 to 2017. So that's how this works out for the contribution analysis. And any particular set of a bar graph which you choose. For an example, if you click on Aditya Birla Sun Life Mid Cap Fund, you can now see that this is the allocation for that particular set of fund. This is the fund's performance, and this is the total portfolio return. So that's the effective way to see how the allocation is actually governing the contribution to the return in the portfolio. And hence you can effectively see that, the higher, let's say for a brief example, if you would have allocated highly towards ICICI Prudential Pharma, you would have had better contribution to the returns, because the total return of that particular set of a fund between these two period was highest or higher than the Kotak equity opportunities. So that's how you can take effective decision making between the two funds. And apart from that, the correlations which we had before, that you can now see that Tata PE fund and Aditya Birla Sun Life, we were comparing between the two. You can now see that one of them is actually having a higher contribution, and even the total return between them, Aditya Birla Sun Life is actually higher between them. So that's the contribution analysis for a client portfolio. It's very useful because it helps us to determine the contribution of the assets in our portfolio in itself. So that's it for the contribution analysis. Let's go ahead with the two more tabs we have. One of them is a stats. Stats is just an overview for the entire portfolio. If you want to take a look towards like how many flexi caps do I hold, how many large cap or mid caps do I hold in the portfolio, and what are the stats of that particular set of the funds in the portfolio, you can effectively take a look into it, and you can easily recognize that there are a couple of equity funds we hold right now in the entire set of a portfolio. Three mid caps, there are two small caps, there are three value funds. And this is also another way to recognize that are we too much concentrated towards one category or not. And also you can check the hybrid funds, like two of the funds do we have, is it's better to have one fund in the dynamic asset allocation rather than having two. So this is another great way to check the stats, and you can also see the stats on a 5-year, 3-year, 2-year return sets for this individual fund. So these are all the individual fund performances which we are showing here, and it also shows you the asset allocation between the funds, so large cap, mid cap, and small cap itself. Now coming to the stats, we also have the performance. Now performance is one of the most important parameter to check whether the entire set of a portfolio is making sense for the client or not. So let's say we are choosing a custom start date, let's say 2013. So it's effective 10-year period we are choosing here. So for the 10-year period, so this entire 10-year period which you see right now is a historical backtest of the current holding of the client. Now, this entire tool is a decision-making tool. What you can effectively do is you can effectively change the start date to actually make a hypothetical analysis whether this portfolio is making sense on a on a volatility basis, on a basis of returns, or on a basis of certain relative parameters against the benchmark or not, right? So this performance will give us an idea that between the last 10 years, so this 10 years we have chosen, which is effective approximate of the 10 years, you can now see the performance from a start date. So this is the performance. And what we do is we do the daily return calculation for the entire portfolio versus the benchmark. Now, benchmark is considered as reference index 2. You can check the reference index 2 here, which is 90% Nifty TRI and 10% CISL bond. It was actually preset by our system due to the fact that we had an asset allocation of 90%, close to 90% equity and 10% debt. And what you can do is effectively check the asset allocation and the asset performance versus the benchmark performance. Now, here the asset performance versus the benchmark performance is very important because Previously, in our last session, what we have discussed was the asset which was there was actually an individual mutual fund. But in this case, is actually an entire portfolio. And on an entire portfolio analytics, what you can effectively see is the historical backtest of the current holdings. And it helps us to recognize that is this asset good to hold? Is this entire set of a portfolio good to hold for the next 5 years or 3 years or 10-year period, right? As you can now see, the annual return is higher than the benchmark. There's an annual volatility which is actually lower than the benchmark. So you can effectively see in the last 10 years, we were actually lesser volatile as a portfolio. And you can also see the Sharps and the Sortino ratio. So these kind of performance stats helps us to recognize between the benchmark. The benchmark can be changed. You can change the benchmark from here. You can keep it as a TRI or an NSE as a benchmark into the system. And you can also see the value at risk. Now, we already had a session on value at risk, because value at risk is a very important parameter to understand the risk of the downside risk of the portfolio, or even a mutual fund if you're taking a look towards a mutual fund analytics. And then what you can do is you can effectively create a probabilistic view. So for an example, in this case, there's a 5% chance to have this loss in a 95% confidence interval. So 5%, because 100 minus 95 gives us 5% as a probability, which can have a loss of negative 18.41%. And you can also check out the benchmark as well, which is actually more riskier than the asset, which is negative 22.46. Similarly, for the implied VAR, what you can effectively check is there's a 5% chance that you can have such a loss, which is 19.82% compared to the benchmark, which is 25.25%. Now the difference between the two is actually the calculation and the methodology. Historical is basically calculated on the basis of daily return sets, whereas implied is calculated on the basis of volatility itself. So these sets of parameters helps us to understand and determine the risk of the portfolio. And normally what we do at capital markets, we only take a look towards return, but taking a look towards risk is very important, because this will help us to determine the risk of the portfolio and to see if it is making sense for the client of our current client in the next coming years or not. Similarly, you can also see the relative stats. So I'm just going to give you an overview of the relative stats here. We have excess return over benchmark. We have this annual return over benchmark, which is effective in alpha between the two periods. We have the tracking error, which shows you, are we tracking the benchmark or not? If you are not tracking the benchmark, the tracking error is definitely going to be higher. And you can also see the information ratio, which is a ratio between the alpha and the tracking error. So higher the information ratio, the better the asset is, because it is different than the benchmark, and it is also getting us a better alpha. So if you see a negative information ratio, that itself shows us that we are not creating an alpha itself, and our tracking error kind of is higher. So that's how it works out. You can easily look towards information ratio to understand the risk of the client profiling. And then the capture ratios, I think the capture ratios are very, very useful, because here what you can do is you can take a look towards the capture ratios in a holistic view. Because here what you can do is, let's say when you click on this I button, you can now see the performance of our asset, which is 43.18 versus the benchmark, which is 49.97. And what it does is it shows the performance of our asset when the benchmark was up. So only those months will be shown here when the benchmark was having the positive performances. And you can see our asset performance accordingly, subsequently in the list here itself. Similarly, for the down capture, when you click on this I button, you can now see the performance of our asset when the benchmark was negative. You can now see all the negative return sets for the benchmark versus our asset. So in this case, November 2023, benchmark had a negative 1.70 monthly return sets, whereas our asset was having a return of 0.90, which is a positive return sets. So hence you can now see that the ratio effectively it's in a down capture is lesser than 100, and lesser than 100 ratio for a down capture is ideal, because that is where you can now recognize that our asset has had a lesser risk against the benchmark in the down capture. Whereas for the up capture, it should be better to have the ratio more than 100, because if we don't have more than 100, you can now see that our asset performance when the benchmark was actually in the bull run, you can now see the performance of our asset is actually lesser than the benchmark. So that's how the capture ratio works out. We also have the monthly and the yearly chart. This is an overview of the monthly and yearly chart. You can take a look into it. As of what it shows is that it shows you in the sense that if you want to make a probabilistic view of a monthly chart, what you can see here is the percentage here. So on a percentage basis, how much of the months this particular portfolio has performed in the last 10 years. And in the last 10 years, is it making sense or not? Because there were 33% of the entire months which were negative. And here you can also check on a yearly stats as well, that how much of the years it has performed positively. So you can now see that all these years, the average return, a positive return was 17.76, but the negative return was negative 5.60. And you can easily recognize them here in the system on a yearly chart basis. So that's how this entire portfolio performance works out. There are other tabs as well, like rolling analysis, distribution, drawdowns, and scenarios. These are all quantitative analysis, and these will actually require a separate session itself for the portfolio analytics to show, how you can actually run these particular set of the analysis. But the main point here is that we are going to be covering the customizable report. Right now, before going the customizable report, I would like to show the consolidation of the portfolios here. So if you want to make a consolidation of portfolios, you can head over to the RTA connection tab, right? And what you can do is you can effectively consolidate any clients. Now, let's say I want to consolidate 4 to 5 clients from one single family. What I can effectively do is I'm just going to be zooming in here in the left side for the preference. You can see this is the filter client portion. Now, here, what you can do is you can search for, let's say, Sharma family. Once you search for Sharma family, let's say any family which you have in your ARN, you can click on this load multiple clients, right? Once you click on this load multiple clients, you can now see that there are the client names here in the left side, and you can now select those clients. So once you start selecting those clients, you can now see that it will show you the number of holdings and the EUM here in the system. Now, this consolidation will happen once you click on this, any particular set of a client itself in the system. So let me just try to consolidate it again. 1 second. Yeah. So once you go to the client section and once you click on the consolidation of the client here, you can click on this load multiple client and start consolidating them. So you can now see that if I'm consolidating the top 5 client here, you can now see that these are the clients which are now being consolidated. Now you're loading 4 clients here. So let's consider this and load 4 clients in our system. What you can do is you can make it as a family portfolio, right? And once you do this, you can now click on this. So the entire 4 particular set of a portfolio accounts for 33 holdings with 5.61 crore as an AUM. Once you click on this done, you can now see that these are the family portfolios, and these are the units and the values of the entire consolidation which we have taken into consideration. Now you can similarly run the similar analytics, just what we have done for the previous portfolio analytics for a single client. Now you can run a family portfolio analytics here into the system, and you will see all the same identical tabs like asset allocation, performance, contribution, stats, correlations as well. And you can now see a huge set of a correlation tool which can help us to understand the diversification in the portfolio on a family portfolio basis. Now here, the point is that you can also create the PowerPoint based report. Now this is a customizable report. What you can do is you can click on it and you can create 2 types of report. One of them is a percentage based report. Another of them is a amount based report. Now I'm just going to be showing you the amount based report, because in the amount based report, it will be considering the asset allocation breakdown with the basis of amount, which is the current value of the portfolio. Once you click on this create PPT, it will now be generated into the system. Now, what you can do is you can effectively run the portfolio here. So I've just preloaded the portfolio for this session. And here, what you can do is you can see that this is the portfolio of the Sharma family, which was previously created before the session itself. Now here, what you can see here is that it's highly customizable. So first thing here is that first it is highly customizable because it is a PowerPoint report. Another thing is that it is co-branded. So you will be having your own logo. So if your logo is updated in our system, you can see your logo here in the system itself, right? And similarly, you can see the capital amount here. So previously, what we were generating the portfolio for was based on capital allocation. So the capital allocation actually shows you the holdings based on the capital. Here you can see the holdings, like for an example. Now this is very relatable in front of a client because you're showing your holdings based on the amount. So you're currently holding 60 lakhs in ICICI Prudential Value Discovery. or you're currently holding 20 lakhs in Aditya Birla Sun Life Equity Fund. So that's a very useful way to show in a lakhs and crores rather than a percentage. We also have a percentage module, or rather than millions and billions, because this is one of the most relatable way for a domestic audience to relate towards on a report level, right? Even on an exposure level, what we have given here is an exposure for an entire set of, so top 10 exposures are given. And you can now see that we hold 10 lakhs in ICICI Bank as a stock through these mutual funds. So there's no point in holding a direct stock, because we definitely hold a huge amount, a huge chunk of our money in our ICICI Bank and HDFC Bank as a stock, right? So that's another way to check asset allocation. There's other ways as well, like asset allocation overview. Now, within asset allocation overview, what you can effectively see is the equity allocation of it. So apart from 1 lakh, we have like 169 lakh as a portfolio allocation. We have given in lakhs that 151 lakhs, which is 1.51 crore in equities. We also have 6 lakhs, 6.47 lakhs in cash. We have 2.35 lakhs in foreign equity as well. So this is also broken down in lakhs. But if you have a allocation lesser than lakhs, you can now see that in thousands as well. So entire uh, PPT will be modeled in such a way that you will see in thousands, lakhs, and crores. Similarly, we have other tabs as well, like position concentration. So we have already discussed position concentration, then equity market cap exposures before previously in our session. Now, this is shown on a capital basis in our report. So I'm just going to show you on a slideshow basis that will be more clearer to everyone. And you can now see that this is the equity market cap exposure for the portfolio. And you can also see the ratings as per the percentage of the total portfolio. And then we have the equity sector exposure, which is also in lakhs. And you can also recognize that we currently hold 29 in banking, 29 lakhs in banking. Now, this is another useful way to relate with the client. And then we have the performance stats. So performance stats, now these will be definitely be in percentages. You can see these performance stats which we have given before itself, and you can effectively choose an as any benchmark to compare it with a particular set of a portfolio. And then we have the rolling analysis tab, and then we have the drawdowns tab. So drawdowns tab is also there. It also helps us to understand and determine the strength of the portfolio in our system. It helps us to determine that there have been losses before, and there definitely in the last 10 years these top 10 losses had also had a recovery. So how much days it took to recover for the client's portfolio is very, very important, because this is another useful way to show the client that this portfolio is definitely a good recovering portfolio, and it helps us in the retention of the client. So this is where you can take a look towards the days to recover, and you can see these are all in number of days, and you can see this top 10 drawdowns here in the system. It is highly customizable. You can change the colorings of the particular set of a PowerPoint here in the system. Now this will depend upon the brand and the brand logo of your company. You can change it accordingly into the system, and that's how this works out for the entire set of the PowerPoint portfolio analysis. Now the PowerPoint portfolio your reports can be generated for a single client and even a family portfolio clients as well. There are other sets of reports. I will just give you a gist of this. We have a PDF based report which you can generate. You can click on this PDF. You can create a PowerPoint. You can create a password based PDF report, and you can effectively also create a share link and a mobile based link for the clients. So for the share link, you can click on it. The entire analytics will be shared with the clients. You can copy this link for the client itself. And then we have the client link. Now the client link is very useful, because here what you can do is you can create a mobile based client link. All the analytics which we have shown was on a web-based level, but here what you can see is on a mobile-based view. So you can effectively generate a random pin or any pin which you would like to have a benchmark. You can see the capital here, and within the capital, you can now share a family-based portfolio basically to your clients on a mobile-based link. Now, this is very, very useful, because you can now see all the entire set of asset allocation, what has been the holdings type, what has been the underlying exposure, what is the analytics. So analytics is also given here. So a client will be able to see this on a mobile phone if you use this link to share it with the clients. So all the performance versus the benchmark, you can see the yearly return sets and the yearly stats and the portfolio drawdowns itself. So these are the two tabs which we have in the analytics, which can be shared on a mobile based view. And then we have the markets tab, which is a generalized tab for the client to review. And the client can also connect with you. So if a client wants to connect with you, he can just write it his review on the portfolio, and then you will receive a mail on this particular set of a login ID mail to your system. So that's how it works out for the mobile based view. And that's how this works out for the entire set of a session. It's a comprehensive session. We have covered a lot of topics here. So I'm just going to taking a review of these topics. One of them was asset allocation. Other of them was a performance, contribution, stats, and correlations. So these were the top 5 tabs you can use for client retention. And one of the most important tab you can use is a drawdown tab as well, because drawdowns is the one which can help you to retain clients. Retain in the sense, when you choose a start date here, 2009 or 2010, you can now see that there are the top 10 losses. And this is where it took, how many days it took to recover. So these are the days it took to recover for that particular set of a portfolio. So that's how this works out. You can now see the start date, start price, end date, and the end price as well, and the recovery as well. So any particular set of a losses have recovered in this portfolio, and that is why you should be actually taking a look towards the retention. So this retention of the client can be used by using this drawdown tab. So that's how this works out for this entire session. I will now open this forum for the Q&A. So if you have any questions, any queries, you can write it on the chat box or verbally, and we will try to address them.
Hi, can you tell this correlation tab how to analyze and how to do some adjustments in the correlation?
Sure.
Sure.
So,
Yeah, go ahead, man.
sure. So for correlations, what we have given is that when you load in any particular set of a portfolio, you can now see that there are 8 items, which are the positions which we have. And once you look at correlation, you will see that these are the funds the client are currently holding. Now, in this case, when you see correlations, as it is daily calculated, you can see that between Kotak Equity Opportunities and Aditya Birla Sun Life Equity Fund, we have a correlation of 0.96. Now, the correlation between them is very high because based on the daily momentum of the both of the fund, the correlation, high correlation is itself a risk. So if one of them had a drawdown in the portfolio, you can see that other of them will definitely have a drawdown because they are correlating highly with each other since the last couple of years. It's not just 5 years or 6 years. It's like more than 13, 15 years, right? So that is why a higher correlation is a risk. So what you can do is you can effectively address them by taking a look towards contribution after it. So let's say if you want to remove one of them, either Aditya Birla or either Kotak Equity Opportunities, you can check towards the contribution and see that between this particular set of the days, which one have been actually a better performance generator. So you can now see the, Kotak Equity Opportunities is actually one of the least, contributing towards the portfolio into the system. And that's how, you can compare between the two, which is Aditya Birla Sun Life is actually having the better contribution. But the point here is you can also check out the total return here as well, because there is a possibility that Kotak Equity Opportunities might had a lower contribution in the lower allocation in the portfolio. So here you can effectively see that Kotak is actually the most lowly allocated fund. So here you can address them by taking a look towards the contribution tab itself. And similarly, for a higher correlation, as I've stated, you can also check in a lower correlation. So definitely a bond fund will have a very low correlation between an equity fund, which is a 0.13 or 1.14. So a correlation closer towards zero is actually a low correlation. It can be said as diversified, but you need to take a consideration of asset class as well, because definitely there's a case that debt and equities might not have too much correlations between them.
So can we assume that if this matrix can be understood properly if we have equal asset allocation to all the funds?
Yes, I mean, even if you have equal, what will happen is on the contribution tab, when you see the first column, total return, that will let you easily decide, at least in terms of performance, what is better and what is worse. Of course, if you want to compare other aspects of the two funds that have high correlation, you can do that in the compare section. But if you apply equal weights to all the funds in your portfolio, then the contribution to return, which is the second column, that can also be used to judge performance, but you can do that anyway from the first column.
Yeah, but one more question is if we see Kotak Equity Opportunities and Aditya Birla Sun Life,
Yeah.
the fundamental itself is different. One is a large cap based, another is a mid cap based.
Of course, that may
So
be
then it
true.
will differ entire process.
Well, that may be true, but what we definitely have is when you look at the correlations, you see that that number there, 0.96. Now this number is correct because they may have different processes. So actually, Umair, what we can do is try and can you take this portfolio to compare?
And there we can see that portfolio overlap.
Exactly. So you can see now the overlap is not that much. Now what this means, if the overlap is low but the correlation is high, this means that the underlying stocks that they have,
yeah, understood,
are highly correlated to each other. So
yeah,
even
that's
though
why,
the process is different,
yeah.
so at the end of the day, your performance, you're still getting less diversification. So that you may or may not want to address that, but that will become clear when you look at correlations and overlap.
Yeah, understood. That's why I came to overlap.
Yes.
In Kannada. Yeah. Thank you.
No problem. Umair, there's a question from someone on the chat saying they just want to look at how you selected multiple portfolios. And while you're doing that, there was another question saying, is it permanent or is it changed? So please note that this is on the fly. It's not a permanent family mapping. The reason for this is all your RTA data is always overwritten every single time. So, every week when it's refreshed, all the data is deleted and we get new data from the RTA. So, this is something that you do as a one-time. So you can click on that load multiple clients checkbox. Suddenly you will see that these checkboxes appear in front of every client name. You can select whichever one you want. And for example, if it's not showing up on a search, so may just change the search. You can, gather other ones also, like something completely different, just filter the clients. Yeah. So like that, you can add more. And you can put a group name if you want. The only thing that does is it changes the name, the top level name of the analytics. In case you're going to print out a PDF or a PowerPoint later on, then you can just name it group 1. And then when you run analytics, all the things that print out, for example, the PDF or the PPT, they will have that group 1 name on it, whatever you write there.
So only single ARN, right? Not multiple ARNs.
Actually, that's a good point. I never. I think you cannot do it across ARNs.
Because a family, we may have 2-3 ARN holders for taxation purpose.
There is one way that you can do it. So may I just load one client from one ARN?
Okay.
And then it's a bit of and you can copy. So where in the portfolio tab, let this finish here. In the portfolio tab, just look at the 2 copy icons. Sorry, the portfolio sub tab here. Yeah. Like one of them is portfolios, the other one is manual, I think. Yeah. So if you click on this, so now this one is in the manual data tab. Now load the second ARN and load another client from that ARN and copy that to the manual tab as well. So just do something else. It's already there. Okay. So now you can load multiple clients from your manual data section.
Okay.
Right. And this way you'll be able to combine 2 portfolios from 2 different ARNs.
Yeah. Great.
Yeah. There was another question. I think the similar lines of what we were talking about. So the question is, what does it signify as low position overlap but high correlation? So this definitely signifies that the underlying stocks in both the funds are highly correlated. So as a simple example, if there's one fund which is holding ICICI and the other one is holding, let's say, HDFC, and we in this example, let's assume that the correlation between ICICI and HDFC stock is very high. The position overlap will show very little because they're 2 different stocks, but the correlation will still be high because the stocks in both the funds happen to be moving very similarly to each other. I think that's all we have on the chat. If there's any questions, please just unmute or let us know on the chat. There's a question saying, can you please explain performance ratio? Which ratio are we talking about here, please? If you could just. So Mayor, if we could maybe just go through, just quickly go through Sharpe ratio, Sortino, and up and down capture.
So basically, when you take a look towards the performance of a single client or even a multiple client, what you can see here is the Sharpe's ratio and the Sortino. Now, what we consider as Sharpe ratio is the risk-adjusted return. The risk in this sense is actually the annual volatility, and the risk-free rate, what we consider is the government bond 10-year. Now here, the higher the Sharpe ratio, the better is the entire set of a portfolio against a benchmark. It gives a better risk-adjusted return against the benchmark itself. Now here the Sharpe ratio is given here. We have also given the Sortino ratio. Sortino ratio is just a modification of a Sharpe ratio. It just penalizes the downside of the volatility. So you can now see that we also have a better Sortino ratio against the benchmark. So these are the two ratios which you can use effectively to compare against a benchmark. The benchmark can be changed from here. Let's say we are considering Nifty TRI as a benchmark and comparing it with our portfolio. You can now see that on a portfolio level, our volatility is much lower. And due to that, we are actually having a very good Sharpe and Sortino ratio as well. So you can see this here in the system. Similarly, for the capture ratios, there are a couple of other ratios as well, like the capture ratios, which shows that when you are having, when the benchmark is having an up month, which are positive months, we on an asset level, are we having a positive return sets or not? Or a return sets better than the benchmark or not? In this case, when you see a figure like 86 or 87 or something which is lower than 100, you can effectively assume that we did not have the better performances against the benchmark in the up months. As you can see, our return set is actually 51.57 compared with the benchmark, which is 59.67. Similarly, when you check out the down capture ratios, the effective ideal down capture is lesser than 100 because of the fact that we do not want to have more losses than the benchmark. If we have more losses than the benchmark, then the down capture will be more than 100. But in this case, you can see the benchmark is actually having a higher loss on the downside period. So whenever then the benchmark was down, our asset performance was actually lesser. I mean, lesser in the sense was actually better than the benchmark in the loss periods as well. So in this case, you can see these ratios. And there's another ratio which is called as information ratio. It is just a ratio of annual return over benchmark versus tracking error. So effectively, a better information ratio signifies that we are having a very good alpha and we are actually different than the benchmark. In this case, we are definitely different than the benchmark. We are having a very low volatility. We are having a really good annual set of a return. And hence our information ratio is to the roof. You can see it's 1.65. It's very phenomenal in consideration with the benchmark itself. But the point here is that, the benchmark I've chosen is Nifty TRI. Now, this might not be an ideal benchmark, so you can effectively, use a reference index as well. We have given some combinations of Nifty TRI and CISL bond, and you can also make your own custom indices. So custom indices is another session anyway, but I'm just going to be overviewing this. But what you can do is you can effectively create as many custom index as many index, and you can provide weightage to them so that you can accurately map the portfolio based on their asset allocation, and then you can accurately create a performance stats relatively against a benchmark. So that's how this works out for the multiple client portfolio analysis ratios, performance ratios, or even a single client portfolio analysis.
Okay, great. If there's any more questions, please do unmute and ask us or write on the chat. Thank you. Okay, so it sounds like that's it. So Mayor, we can close for today.
Sure. So thank you so much, everyone. We will come up again next week with different sets of topic. So you can always write us on support@engineresearch.com. I'm typing this mail for your own convenience. And you can also take a look towards our YouTube channel and Twitter as well. So we are constantly updating our system. We are trying to take all your feedbacks and making those tools for you to analyze and make proper decisions for your client. So hopefully this session is useful. You can use this entire set of the analytics for client retention. And to get over to the YouTube channel, you can either search Engine Markets on YouTube, or either you can click on this videos tab, and it will take you to the entire set of our YouTube channel. We are constantly adding all our short form videos as well. We have more than 150 videos now, and here you can also check out our webinar recording, so they will be uploaded seamlessly once the webinar is completed. So that's it for today. Thank you everyone, and have a nice weekend ahead.